get started talking about triangles. Now, I myself am a chart pattern trader. I trade from chart patterns, specifically triangles, support and resistance, and some key candlestick patterns. That is it. I don't use oscillators and indicators. I trade from price action and reading my charts. Now, chart patterns are well documented in technical analysis literature and are based on the psychological phenomena that occur between buyers and sellers of financial instruments in the liquid markets. Pattern formation on their own do not form a trading system, but rather provide an indication of the future trend of an asset as the price breaks key psychological barriers in the form of support and resistance. Now, I am sure that you've heard about chart patterns. There are no super secret sauce, and there's some very well-known patterns like double tops, double bottoms, triple tops. You read in the newspaper, especially like Bloomberg or Wall Street Journal, all the time about head and shoulders. You read about the Golden Cross. Okay, we have rectangles, we have triangles, we have it all. In fact, let me pop up a chart I have here for you. Oh, come on, computer. There we go. Here's just some of them. The head and shoulders, the inverted head and shoulders, double tops, double bottoms, triple tops, triple bottoms, falling wedge, rising wedge, flags, pennants, consolidation. They're all considered chart patterns. But these are the primary ones that we fall into what we call market structure. Now, I personally, and I can only talk about it, I pay no attention to bull flags. Double bottoms are just, to me, a waste of time, especially in the type of trading we're doing. We see double bottoms every 2 seconds. But if we look at things like bull pennant, ascending wedges, descending wedges, bear pennants, expanding wedges, what do they all look like? They all look like triangles. So I lump all of these together as triangles. Just like when we were in grade school, the teacher explained to you a triangle is 3 sides with 2 converging upon each other. Sometimes they're at the same angle, sometimes they're at different angles. Sometimes we'll have a triangle that looks like this. Sometimes we might have a triangle that looks like that, but they're all triangles. I lump them all together. Now, there's lots, and we're going to talk about it. There's lots of gurus out there. There's lots of technical analysts. There's lots of people who give all types of interpretations to all of these different triangles, whether it's a symmetrical triangle, ascending triangle, descending triangle, whether it's a pennant. I tell you right off the bat, hogwash. Because a lot of that, or a lot of these chart patterns, made a lot of sense not long ago till the markets were a slower moving thing. And we had time to look at our stock prices and things move slowly. And you could plot these ascending, descending triangles out and form some type of opinion. We're trading today in online, fast trading, moving markets. And when the triangle pattern appears, is specifically formed on a price chart. They're typically identified when the tops and the bottoms of price action are moving towards each other, like the sides of the triangles. So whether we have a triangle moving that way and prices moving the apex this way, whether we have a triangle and the price is moving the apex this way, whether we have a triangle that's moving this way and the price is moving into the apex that way, they're all triangles. But the important part is when the upper and the lower level of the triangle interact, traders expect an eventual breakout of the triangle. And that's what becomes crucial to us. Trying to predict what price is going to do and what the market's going to do and what trade you should be taking before anything happens is kind of detrimental to our health. It takes too long. The only time that we can actually make a judgment, and the only time we can possibly get a trade is when price breaks out of these triangles. So as such, many breakout traders use triangle formations for identifying breakout entry points. So as we can see, we have an upper line, a lower line, all converging to form an apex. Okay, so what we're looking at is actually typically called a symmetrical triangle because the angle of the upper and the lower line are at the same degree. Okay. Now, there are different kinds of triangles that can be seen on a price chart. But before you jump into triangle trading, you should understand the difference between the formations. So we're going to give you a little knowledge. We have the symmetrical triangle. The symmetrical triangle, both lines, the support and resistance lines, or the top line and bottom line, are, I'm going to stop for 1 second and ask you very, very much. I spent years teaching class. These classes are built no different than if you attended a college professor standing up on a podium teaching you something. Okay, we're going to go from the beginning to the end. Okay, I promise you, I will cover everything. But writing in every random question that comes across your head doesn't help. Okay, we haven't even talked about what a breakout is and how to. And I have another people typing, but how do I tell what's a fake breakout? We haven't even gotten to that point yet. We're just learning about what a triangle formation is. So I would appreciate it if you would spend the time listening, following along, and when we get to a point that you don't understand, ask about that point. Okay, I'm not going to go spend my time right now talking about fake breakouts because we're not in that part of the class. Okay, so please follow along with me. Okay. So right now we have a symmetrical triangle. Symmetrical triangles, the angles are in the same degree. And we have an upper and a lower, and what we have is also the base of the triangle. The base of the triangle is very, very, very important. And we're going to learn why shortly. Okay, figuring out where the base of the triangle is very important. Because see, in this example, this is not the base of the triangle. Okay. The base of the triangle would be from where both lines had started. Just because the line started here, the support line started, we didn't have a top line because this could have been all the way out there. At this point, we have two lines that we can actually form that triangle. We couldn't form this triangle here. So the base of the triangle is when you can actually draw the base and connect the upper and the lower line together. And this is crucial because we use this base to do some measuring to figure out where our stop loss should be, to figure out where our potential profit should be, and to figure out what our risk management should be. It is quite important. So keep in mind that the base is when you can attach the two lines, the upper and the lower, together, regardless of what type of triangle we're looking at. Well, let me just get my markings off of here. So we have a symmetrical triangle. Now, the symmetrical triangle is a situation in a chart where the tops of the price action are lower and the bottoms are higher. Also, the two sides of the triangle are inclined with the same angle. Now, if you notice in my little sketch over here, we've taken this base and we haven't made an assumption. And that's the problem. Too many people make assumptions. There's too many rules out there saying, well, if the symmetrical triangle appears during an uptrend, then the price should continue upward. Believe me, I've tested it, and it's like 58 to 42% correct. It's not enough to make us follow this rule. But we could then take the width of that base and apply it when we get the breakout, because we have no idea whether it's going to break up or down, to determine where we would have to set our target. Now, a target point is very, very important because you need to have a good target point in order to calculate your risk-reward ratio to see if you can actually make that trade based on your risk management and whether you want to make that trade. So then we also have ascending and descending triangles. And we have the same thing. The rule of thumb, which is the old thumb that we should amputate, says that an ascending triangle, the price should break out in the direction of the previous trend. And that would be an uptrend. In a descending triangle, same thing, but that should be a downtrend. But again, I've tested it. And I think somewhere towards the end of the class, I show you what the ratios come out to be. It's not enough to make that jump. And if you do, you tend to make the wrong decision. What's critically important is that you know that you have to watch for the breakout and what to do when you get the breakout from that pattern. Now, once you've got a triangle forming on your charts, we need to wait for price to break out of that triangle. The farther and farther it gets pushed into this apex, the more likely we're going to get a breakout. But like we have here, we have a ascending triangle on an off of an uptrend, and the rule of thumb would say it should break out upward, but it didn't. It broke out downward. You cannot make a decision based on one single candle. And you have to wait for the close of that candle anyway. Because a lot of times, you might get a high of a candle breaking out upward. But that high doesn't tell you anything. Okay. You know, many times we get some weird highs during the day. You have something that has some crazy momentum. The first thing you can think about is being a justified breakout is when it closes outside of the triangle. But a lot of times it will return right back into that triangle formation. So this is where you can get in trouble. Because the question is, how do you know that it's offering an opportunity? And whether it's a rising wedge, whether it's a symmetrical triangle, whether it's a bearish pen, whatever it is, we have to wait till we get the breakout. Okay. Now, the rule of thumb, whether it's symmetrical triangle, ascending, descending, no matter what it is to wait for the candle to break out and wait for the next candle to be your confirmation candle. And you would possibly consider opening a trade on the third candle. Okay. Maybe on the close of the second candle. But you need some type of confirmation that it wasn't just a weird candle or it wasn't just returning into the price. So you would set your buy at the, let me get my marker back on here. At the open of the second candle, and you would set your stop loss at slightly below the lowest wick prior to the breakout. So the easiest way to interpret a chart pattern is to treat it as if it was a continuation breakout. Just wait for a clear break above or below the support or resistance line. So what we're looking for, though, is because this happens quite often, you have to be able to reduce it down if you're going to trade it to say, okay, I have a potential. Now, ultimately, the breakout should be supported by volume. It should also be supported by an increasing trend. In other words, and the quality of the trend. You can have an ugly looking triangle with a whole bunch of mess in the center, which is in reality what you get. And then you could have a weird breakout here, and it probably could go that way. I can't promise you it will or it won't. But the quality of the trend and the overall movement, if you have a trend that is moving this way, and it's a nicely well-developed uptrend or downtrend, and you have a triangle that's developed within that and contains that nice developed trend, you have a much more reliable signal. And since I'm always looking for high probability trades, I'm always looking for the cleanest signal I can get. Now, we also want to look at volume. Okay. Volume, as the price moves into the apex of this channel, the triangle, you should see volume start to diminish. We call this the calm before the storm. When price breaks out of that triangle, regardless whether it breaks up or down, because you don't know until you have the breakout, volume should start increasing. Okay, that will support the move. You also have to look at the duration, whether this is a triangle that just popped up in a couple of time frames, or it's been forming for a long time. And then the future direction of breakout can only be determined after the break has occurred. Sounds obvious enough, but attempting to guess the direction of the breakout can be very dangerous. Even though a continuation pattern is supposed to break in the direction of the long-term trend, this is not always the case. A break should be on the closing basis for it to be considered valid. Some traders apply a 3% breakout. Sometimes it must be sustained for 3 candles or 3 days if you're looking at it, to filter and confirm validity. The breakout should occur with an expansion of volume, especially on upside breakouts. Okay. Now, after the breakout, up or down, the apex can turn into future support or resistance, and sometimes returns to the apex or the support or resistance level around the breakout before resuming the direction of the breakout. And this is hence why we wait for the close of that second candle. And then we also want to look at our price targets. If you take the base of your triangle and lay it on the breakout and say, okay, this is where my target should be, and you'd be surprised how reliable that is. But between the target point that you're setting based on the base falls a major support or resistance level, you cannot use that target price. You have to drop it down to above or below that next major support line or resistance line, because that's most likely where it's going to stop. And then you have to recalculate your risk-reward ratio. So you always should need to be aware of your price targets. So I've got some triangles built on some charts, so let me pop them up on the screen here for you. Okay. This is today's chart. Okay, it's for an ETF. But here was a long-term triangle developing. And we got a nice little breakout right here. And the price moved up. And look what it did after it broke out. It formed another triangle. And then it broke down. We could have traded this trade here. And then it broke down out of this triangle and came back down to this previous support level. And you could have gotten that trade in. You had 2 opportunities. It happened to be, it's rare that it happened this way, that we got a shorter term triangle within a long term triangle. But here where we got the breakout here, Okay, let's back up here. Okay, here we got a breakout, but then price returned back into the apex. It broke out again, and then we got the confirmation. You could have taken this trade, but you see if you use this base, okay, you would have set your target point way up here. But we had a major resistance level right there, so we had to recalculate it to there. Then as it formed this new triangle, we got this nice little breakout here, a confirmation breakout. We could have traded here on the third candle and made some profit down to here. And if you would have measured your base from there, look what happened. You would have made exactly what you should have gotten. So in sum, triangle patterns are easy to spot and provide good risk-reward opportunities. Trader can quickly learn that a big move may be near, as well as the profit objective and the amount to be put at risk. Now that you have the knowledge of these three powerful price patterns, you are steps closer to becoming a more confident trader. Now, the important thing is to use the quality of your trend, your volume. If your volume doesn't support the breakout, just go away. If it's a messy triangle, and look, trading and trading charts are always messy. But if you have this nice triangle formation, but you have a mess in the center of it, you'll understand the quality of that signal isn't going to be as good. And thirdly, you have to wait for that confirmation candle. Just because it breaks out, and if it breaks out strong, just don't jump in there and make a trade. Okay. And then you also have to formulate your base, use it to set your target points, and figure out where you'd have to put your stop loss slightly below the other side triangle, below its lowest swing low, and calculate your risk-reward ratio to see if you can afford to make that trade. But the fact is, your trading decision has to come very quickly from when you have a breakout. It's not something that you're looking at a 1 hour chart and you think you have another hour for the next candle to form. No. You should be looking at this in short-term time frames and using this to find entry and exit points and entering a trade. And therefore, you have to be able to make your decision quickly. And the only way to do this is to practice. Don't trade it. Practice it, okay, until you feel comfortable with it. And then once you see and understand how it works, you'll be able to make your decisions pretty quickly as to whether it's a valid signal or not a valid signal, where to set up your stop loss, your take profit, and get into that trade before that third candle is finished. So you have the time from the close of the breakout candle to the confirmation candle to just a very short time before you can make that trade. Because if you miss it, you could miss the whole entire move. Okay. But breakout candle, confirmation candle, trade entry. Your trade should be entered at the estimated price entry point, should be at the high or not the high or low, the open or the close of the breakout candle, whichever way whether it broke up or broke down. Okay. And stop loss should be slightly below. Your target point should be equal to the base of the triangle. So, like I said, if you have any questions, just type them into the box or go to www.alvexo. And click on the chat now button, and somebody would be glad to answer your question, or click on the contact us button if it's a long question, and just write in, and somebody will respond to you right away. So thank you very much, and have a great trading day. Good night now.